What's going on, everyone? It's Joe, aka the Nomad Investor, where dividends freedom anywhere is the goal. And today we are back with another portfolio update. Today I will be covering the new positions that I've entered into, some news, as well as some things to keep in mind. And most importantly, Nvidia earnings are coming up. So I want to talk a little bit about that and what I personally think is going to happen. So without further ado, let's dive right in. As of today, we are currently at 1,033 subscribers on the channel. Thank you all so much for tuning in and following me as I document my journey. And we have 40 videos on the channel, and I'm currently filming the 41st video, which is also the 39th portfolio update. So if you are new here and you haven't already, please smash that subscribe button. It helps keep me motivated to continue making videos like these. And most importantly, make sure to smash that like button, as it does help with the YouTube algorithm and growing my channel. As always, the videos on this channel are for informational, entertainment, and educational purposes only. I am not a financial professional or advisor, and nothing here should be taken as financial, investment, or tax advice. Investing always carries risk, and those seeking financial advice should seek out a registered professional. Now, this is my game plan and goal for growing my small portfolio from $0 to $1,000 per month in dividend income. And if you haven't been following my journey yet, recently I actually just restarted my whole portfolio. I sold everything last Friday, and up until yesterday, I had not been in any positions because I was waiting for some things. I was reconsidering my strategy, my approach, and what have you. And thank you to everybody who commented, whether it was positive or not. I read every single one of your comments, and I truly listened, because I don't know everything, nor do I pretend to know everything. I am just trying to learn, who's trying to earn, and most importantly, who's trying to, document his journey and see where this goes. I have two sources of income currently. I have remote work income and I have business income. Remote work is stable and the business income fluctuates up and down. Have committed to contributing anywhere from $300 to $1,000 per month into my Robinhood taxable brokerage. And I'm treating my brokerage like a business with the goal of aiming for 30% plus high yield. Now, the way that I aim to achieve this is through investing primarily into these two types of funds: high yield ETFs and stable income ETFs. And these are some positions such as KQQQ, QDTE, BLOX, HOW, CHPY, and more. I have committed to having a max of maybe 5 to 7 positions that are contributing towards this ultimate goal. And I'll be alternating between anchors and satellite ETFs. This is in alignment with the core satellite investing strategy, investing approach. You guys can do your own research on this if you would like to learn more. But basically, just to kind of give you a high-level overview, I'm going to be focusing on more core and anchor ETFs that are more indexed, and that be a big portion of my portfolio. And then the remainder percentage will be in satellite ETFs, as is in the strategy, which would be more high yield, high income, more high risk, high reward type things. So now I will be reinvesting my weekly or monthly dividends, depending on the funds that I'm invested to at the time, through manually dripping. So instead of me automatically dripping my portfolio, I'll basically just be stacking every dividends that I get paid out and purchasing whenever the market is down, or if it's below my average cost per share and things like that. Now, the reason why I'm not doing automatic drip is because when you set drip on, it'll actually just do a regular market order. And the problem with that is it will fill more oftentimes than not at a higher price than what the current share price is on, for instance, Robinhood. So if it's showing $52.33, you may actually get your order filled at $52.44, just as an example. Versus if you do a limit order buy, you can kind of control what's the max price you're willing to pay. And sometimes you can even get that order filled in way lower. I've had that happen multiple times. So that is why I am doing manual drip and not automatic drip. But drip plus always compounding is the portfolio growth strategy. And basically, I'll be rinse and repeating this until my account hits $1,000 a month in dividend income. Disclaimer again, none of this is financial advice. This is strictly for entertainment purposes only. I am just some random dude on the internet. Don't follow me, don't copy me. And most importantly, this is just me documenting my journey. And if you guys get entertained by it, there we go. Next, I wanted to briefly touch on my dividend income milestones. This is while I'm growing my small portfolio. And basically, this is so I celebrate my small wins leading up to the bigger goal along the way. Now, with my old portfolio, I had already achieved the first and second goal. And because it's still November, and if we look in my dividend log, which I'll share with you guys later, you can see that I've already achieved the first 2 goals. Now, I am uncertain if I will achieve the 3rd and 4th goal, which is what I originally had set out, because again, I did restart my portfolio, but we shall see. And you guys can pause this and look at all the milestones leading up to the big one for me. Now, as I mentioned, these are all my dividends that I received from my sold positions. So it's $253.07. So So far for the month, we've already achieved the first and second goal. We shall see if we're able to reach the third goal. I highly doubt it unless I really go full bore in, but I just wanted to be transparent and share that with you guys. Diving into Robinhood so we can look at the portfolio. Currently, my portfolio is sitting at $5,532.55. Pre-market, we are down 0.02%. And if you take a look here, we have cash of $4,535.62. So it has decreased since the last update. And the reason why is because I purchased about 4 positions. And my margin total that I could use at some point once my cash is used up is $7,607.29. So my total buying power as of right now is $12,142.91. So I haven't used any margin or touched it yet, and there's a reason for that, but I'm strategically starting to small portions, small allocations into the positions that I want for my portfolio, which I'll cover shortly. So let's dive in. First, we have KQQQ. This is by far my biggest position as of right now. It's currently sitting at $28.51 a share. We are at a market value of $427.65. I am up $1.20 or 0.28%. My average cost per share is $28.43. So I was able to bring it down lower than what I had originally purchased with my old portfolio. So I'm pretty happy about that. I have 15 shares and my portfolio diversity on Robinhood is at 42.90% with a maintenance ratio of 25%. So again, I haven't used any margin on this just yet, but I am just sharing that with you guys for future. Next, we have CHPY. CHPY is currently sitting at $53.11 a share. My market value is $265.55. I am down $6.45 on this position, or negative 2.37%. My average cost per share is $54.40. And I only have 5 shares because it is pretty high, and I'm going to be paying close attention to see if we get any pullbacks for this position, especially with Nvidia earnings today. So we'll see. But my portfolio diversity for this one is 26.64%, and it also has a 25% maintenance ratio. But like I mentioned before, I am not using any margin yet. Next, we have QDTE. It's currently sitting at $34.16 a share. My market value is $170.80. I am up 0.05 cents or 0.03%. My average cost per share is $34.15. I have 5 shares and a portfolio diversity of 17.13% with a maintenance ratio of 25%. Next, I've got BLOX. So I ended up starting a position in BLOX again. I'm just going to kind of give it another chance, another shot. And this time I'm going to be controlling my allocation size. I think this would fall into like my mystery category that I had mentioned in my last video. But yeah, it's currently sitting at $18.99 a share. My market value is $132.93. We are down 0.52 cents or negative 0.39%. My average cost per share is $19.06. I have 7 shares with a portfolio diversity of 13.33%. And again, a 25% maintenance ratio. So far, all of these positions are 25% maintenance ratios. So if ever in the future I were to use margin for this, that would be something that I could work with a little bit better. Now, I did want to dive right into my dividend nomad sheet. This is the current state of things. So this is my market return and total return. Aside from like KQQQ, everything else is currently in the negative, which is totally fine. Again, I have small allocations. I still am sitting on a lot of cash. I am waiting for the Nvidia earnings to come out later this afternoon, later this evening, depending on what you classify that as. We'll see how the market reacts. We'll see how things perform. I personally think that Nvidia's earnings report is already priced in, and we'll probably end up seeing a sell-off, as we have been seeing more recently with plenty of other companies' earnings, even if they have an earnings beat. But we'll see. Nvidia does control a big part of the market, so I may take a pretty decent size hit in all my positions. But again, because I have such small allocations, it shouldn't move my portfolio too much or put it in such a bad position. So if that were to happen, I'd be able to buy in at better prices, which I'm all for right now. Taking a look here, I'm not going to be covering the total return percentage because I haven't received any dividends yet. So I'll just cover market return. So I am down as of yesterday's market close, because that's when this data gets pulled on the sheet. It's down 0.31% for BLOX, down 1.19% for CHPY, down 0.09% for QDTE, and up 0.28% for KQQQ. And then again, I did want to share the dividends that we have received. So for the year, we're currently sitting at $569.38 in dividends received. And for this month, we've already received that $253.07, like I mentioned earlier. And then I did want to hop real quick into my contribution / allocation calculator. This is kind of so I can have a rough idea of what allocations I want to do. This is not perfect. That's why it says 120%, but this is how I am breaking things down in terms of shares and, dollar amounts if I were to divide up my contribution amount amongst these funds. We'll see how I feel about getting back into any of these positions. I have pretty high convictions in the underlyings. However, I am still waiting because I think Nvidia earnings is going to play a big factor on the market because it's like $5 trillion. And I showed you guys in one of my other videos, like comparing Nvidia's market capitalization versus other companies that are in the stock market, for instance. So it does have a big weighting, and it will pretty much determine how other funds are going to react as well. Now, real quick, I did want to hop on X. If you guys aren't following me already, I have a goal of getting to 100 followers on my X account. On here, I post live updates. I post when I buy or sell positions. I post my opinions and so much more as it relates to the markets. So you can follow me at I'm Nomad Investor. And again, that's at I'm Nomad Investor. First things first, we're going to hop into this post by Beat the Bots. It says, huge WPAY rebalance news. Roundhill finalized the weekly pay universe update effective Monday, November 24th. So this upcoming Monday, November 24th, they are going to be adding to their holdings for WPAY. ARM Holdings, Alibaba, Costco, and Uber. And they're not adding the GLDW or GDXW because those are commodities and not stock ETF holdings. So this is the basket WPAY will track starting November 24th. So I'll just share this real quick. You guys can see all the tickers. You guys can pause this and go from there. Next, we have a post from High Yield Hustle. He says, high yield funds with minimal drawdown the last month. So first is LLII. This is a RexShares position. I'm not sure what company this is or what it's following, but it's up 12.06%. The next one is GOOP. This is actually a curve fund that's following Google. So shout out to Howard Chan. He's been doing a phenomenal job, clearly. But it's up 9.63%. AMZP, another one from Curve, up 1.74%. And then there's SPYI, which is down negative 1.95%. TSPY, which is negative 2.25%, and QQQI, which is down 3.23%. So all of these funds had minimal drawdowns this last month, especially with this correction, especially with this pullback that we've seen in the market. I'm probably not going to invest into any of these personally. I am pretty happy with what my new game plan is. And yeah, I'm just going to try my best to stick with it and see how it performs overall. And you guys get to see that with me. Next, we have a post from Vlad Tenev, however you pronounce his last name. He's the CEO of Robinhood, for those who aren't aware. He says, markets now pricing 51% chance the Fed maintains current rate in December. I'm hoping that's the case. I definitely don't want to see a rate increase, and I don't think it would make sense to have a rate decrease as much as some people might like that, just because there's a lot of data that doesn't really contribute towards that even making sense. But it is what it is. This was cool. So I saw this yesterday and I actually reposted it. Tom Crown on X said, we are so back. And that was when we were up 1% yesterday in the market, which is super funny because that's so real. So many times, it's up just 1% and everyone sees green, they're like so relieved, so happy. I think it's partially a psychology thing. Maybe I'm wrong. I know for me, definitely, when I see green on my portfolio, which I did see yesterday when I first entered in my positions, I was pretty stoked. And to be honest, even though it wasn't by much, I think it was up 0.05% up. Anyways, I wonder if any of you guys can relate. Comment down below if you could. Then we have something interesting. So actually, someone has been commenting on a couple of my videos and they mentioned that I'm blinded by my bias. And to be fair, that could very much so be true. Just for clarification, I come from the tech world. That is kind of where I've established my career personally. I have worked with many different companies on many different initiatives, specifically regarding AI and machine learning, just to kind of give you guys some context. So that's why when I talk about the AI bubble, I'm not speaking from a stock market or stock investor or just investor as a whole perspective. I'm speaking from working in the industry, seeing what companies are doing, decisions they are making, and where they are headed. All right. That being said, I can't share too much because of certain limitations I have, but it said some bubble in this post by Patriotic Ape. It says, putting the AI bubble in perspective per FT. Now it's showing the NASDAQ 100 since October 2022 versus historical series. So this is rebased the start of the bubble. So 100 equals a first month. So the NASDAQ is currently not anywhere near the Great Depression from 1921 to 1932. For the gold boom, that happened in 1976 to 1982. Again, not even close. For the Japan asset price bubble in 1986 to 1992. Again, not anywhere near. The dot-com bubble that happened in 1994 to 2002. Again, not anywhere near. The US housing bubble from 2000 to 2009. It's actually a little bit higher. And then for the China stock market bubble 2005 to 2008, as you can see, it hasn't reached the heights that the China stock market bubble has. But as you can see, we are above where it ended up dipping down to during that time. So I thought this was really interesting to take a look at because, again, I have not really been looking too much into old data from the stock market relating to different bubbles that we experienced and how it impacted the stock market. I'm very, very curious what everyone else's thoughts are in the AI bubble. And just to be clear, the person who commented on my video regarding their opinion on why the AI bubble will burst, I completely understand where they're coming from. They make a lot of valid points, actually, and I'm not in disagreement or anything of that nature. And I am speaking from my personal opinion and perspective, which could always be wrong. I'm a human, and I'm not trying to say I am right and everyone else is wrong. I have no idea. Like I said, I'm just speaking from my background, my expertise. It doesn't mean that I'm right. It doesn't mean that I'm correct, okay? Next, we have this post from High Yield Hustle. It says, allocate to where you know you'll get through to peak returns on both price change and total return. That's the pullback winning recipe. And then he is quoting this post, which we're going to hop into right now. So it says, are you buying a falling knife? Yes and no. The real answer depends on strategy. Let's break down how to know where to allocate during a pullback in high yield. The first mistake and assumption is that all funds operate the same. This couldn't be more false. Knowing the option selling strategy a fund uses is how you know if it's a solid buy during a pullback, no matter how far the drop. Ask yourself, how much is the upside capped? Is it selling covered calls, put credit spreads, or something else? Do I love the underlying stock or asset? Certain funds are a hard pass for me during a pullback. Why? I want true compounding. I want to know I'll get share price growth on top of the dividend. That's why it has to check these three boxes. Limited upside cap, strategy built for yield plus upside, and great underlying asset. Let's break down some funds that check these boxes. NEOS, QQQI, SPYI, and BTCI. Why these? NEOS funds go for a more conservative yield at 12 to 28%. The yield is lower, but that's because they aren't capping all the upside. This creates growth from the lows on top of the dividend. That fear of, I'll never see this price again when a fund drops, isn't there with NEOS. The price change and total return percentage of the April low to the peak was massive because of this. How about another yet more aggressive favorite of mine, BLOX? Why BLOX? This isn't your standard cap strategy. They are long the underlying and sell put credit spreads for income. That means they can harvest the yield without capping upside. Unlike many other funds, this one prioritizes capital appreciation. If you're patient, you're looking at a massive upside on top of the 36% yield. Check out the massive price change on it through the peak and then factor in the dividend on the right. Now, this is a BTC/ETH/high beta fund, so can it head lower? Absolutely. But with that said, it has the ability to recover every dime of that drop, which allows me to be confident in my investment. So it shows the price change percentage on the left, which is 43.20%, and then the total return percentage on the right with 57.40%. And this is ending as of October 8th, just to be clear. And then lastly, it says, it is absolutely crucial to understand the strategies deployed to allocate properly. Just because a fund manager is making the trades for you doesn't mean that's an excuse to not understand what they're doing. When you put that work in your conviction, I don't know what he meant by this last part, but he says, when you put that work in your conviction, your long-term gains will be rock solid as well. I think that's what he meant to say, but it is what it is. And then I'm going to ignore this last part because he's clearly shilling his community. Next, we have a post by Richie B, aka Wanna Be Fresh. He says, Japan's 30-year yield just hit the highest level ever. And I feel that's been flying under the radar. To keep it simple, think of Japan as a giant bathtub that used to have cold water only, near zero rates. So everyone kept leaving to take warm baths elsewhere, like US stocks, crypto, tech, and etc. Now Japan has finally turned the hot water on. The water is warming fast, so money that used to flow out of Japan may start flowing back in. When a huge country like Japan changes the temperature of its bathtub, every other market feels it. Too long, didn't read? it's not doomsday per se. Japan hitting record bond yields just removes a tailwind for US stocks and crypto, which can make things choppy short term. Long term, still intact. And here is the chart that he's referencing from bar chart on X. It says just in Japan's 30-year bond yield jumps above 3.3% for the first time in history. And then we have this last post from Beat the Bots. It says Rex growth and income ETFs and their weekly distribution announcement with the latest yields rank. So I'm just going to focus on the first three, but you guys can take a look at the rest. So it says TSII is the winner with 107.96%. LLII is the second place at 79.53%, and NVII is third with a 57.94% yield. Now, if we hop into Yahoo Finance, so the biggest headline that everyone would be paying attention to is Nvidia earnings, of course. So the first one is Wall Street braces for Nvidia earnings. It says the chip giant's high stakes results come amid growing Wall Street nerves over the AI trade. Here's everything to expect. Nvidia is currently down 2.81%, and AMD is down 4.25%. So this could be an opportunity to kind of wait things out, see how the market overall performs, and possibly either in the after hours or the next day, I may see some buying opportunity to get back into NVIDIA or something else related to AI. And then if we look at the futures, everything is actually in the green. So we are up 0.34% for the S&P 500, 0.14% up for the Dow, 0.42% up for the NASDAQ 100, 0.45% for the Russell, up 6.70% for the VIX. The VIX is currently sitting at 23.88, and 1.12% up for gold. Everything's looking green. It could be a greenish day, at least initially. We'll see, and I think the Nvidia earnings contributing to this, but I do think there will be a sell-off probably closer to the end of the evening. And then I just really quickly wanted to share this with you guys because last time I wasn't able to do it due to the Cloudflare issue, but I wanted to compare RexShares NVII versus Roundhill's NVDW. As you can see, NVII for the 6 month, which I think is fair because that's kind of when RexShares basically launched their fund. You can see that for price change percentage, it is up 15.33% versus NVDW is only up 1.50%. Now, of course, that's as of present day. So they are handling things a little bit better than NVDW over at Roundhill. And then if we change this to total return percentage, I think this is where it's closer tied. So NVII is still the winner at 39.05% versus NVDW is sitting at 38.13%. And if we take a look at the yield, obviously NVDW takes the win for the dividend yield, but I think NVII honestly has a better strategy in place compared to Roundhill's NVDW. Anyways, guys, I hope you enjoyed today's portfolio update. Let me know what you guys think about my new positions, my entries. Was it smart to just kind of go in just a little bit to kind of get a base and just kind of DCA down from there and see also how the market reacts? What do you guys think? Is there anything you think I should have done differently? Comment down below. Also, if you guys are new here and you haven't already, please smash that subscribe button. It definitely helps keep me motivated to continue making videos like these. And for everyone else, smash that like button. It does help with the YouTube algorithm and helps the channel to grow. So if you guys have any comments, questions, suggestions, or feedback, comment them down below. I'd love to hear them. I read just about every single comment, and I try my best to respond to each and every one of you within reason. But until next time, guys, peace.